Great. Good day, everybody. Let's get started. So welcome to today's webinar regarding e-commerce brand valuations. We now do this on a semi-annual basis. We did it last time back in October and look forward to updating you all today with our latest thoughts and where we're at the end of April. So let's jump in. First of all, I want to give you a brief update on a few items that we're working on at the Fortia group. And then we'll walk through the April report with lots of great speakers. We have 6 speakers in total today, internal at the Fortia group and 3 external speakers. And then we'll leave time for some questions at the end. To submit questions, please do it via the Q&A tab on Zoom, not the chat tab. It's much easier to organize. And as ever, the recordings of all of our webinars and all of the talks at our conferences, for example, in New York back in January, they're all available via the YouTube channel, just put in the Fortia group into YouTube and you'll see all those recordings from the last few years. So regarding the Fortia group, for those that don't know us, just want to double down and emphasize who we are, what we're about. We're an M&A advisory firm, predominantly sell side focused on the lower middle market. So to that, in our definition, it's deals in the $10 million to $200 million range. After that, above that, it's sort of my former colleagues at the Morgan Stanleys and Credit Suisses of the world, and below that, it's sort of micro deal size. So that's where we like to play. We have an update on the sectors that we play in. We started in e-commerce, as most of you will know, about 5 years ago. We're well known in that space. We've broadened out to cover digital agencies. That's a very recent initiative. And we're also looking to work with SaaS businesses and AI and data businesses. What's interesting about our firm is that we have operational experience in all of those 4 sectors. So we only choose sectors where one of the co-founders has genuine operational experience, as opposed to just being bankers who don't really understand the sector from an operational perspective. Before we jump into today's discussion, I want to just touch on some data points that we see about sellers being exit ready, and hopefully it's of interest to the buyers on the call. We're trying to educate sellers in e-com to become more exit ready, which makes the exit process smoother, which I'm sure the acquirers on the call value. And I think it's upon us all to sort of improve the bar, and improve the standard as we go. So here's the challenge. Most entrepreneurs are not ready. So a lot of entrepreneurs just don't do planning. 80% of business owners lack a written exit plan, and 50% have not engaged in any form of exit planning. That's pretty scary. That's a stat from the Exit Planning Institute. And very little firms have an appraisal. Despite 41% of entrepreneurs saying they'd like to exit on a 5-year view, only 48% have a plan. So there's a gap there, and nearly 60% have never had an appraisal on their business. So there's a problem that needs to be solved, and we're trying to help solve that. The problem, what are the consequences? In reality, 70 to 80% of the businesses that go to market don't get sold. So if you're not prepared, you're clearly going to be more likely in that group, which is where no one wants to be. And even if you do get the deal away, there's clearly likelihood that there's an impact on valuation if you're not fully prepared. And the stat here from Sunbelt is that owners who fail to plan may lose 20 to 50% of potential value. So it's pretty severe consequences if a firm isn't planning a sale properly. So what's the opportunity? The opportunity is to become exit ready, is the term we use. So what are the benefits? The benefits are actually getting a deal done, so becoming part of the 20% club, and getting a deal done at a higher valuation. There's a stat here that's showing that companies that become exit ready 1 to 2 years out can achieve 15 to 24% higher valuations. So it's not, by exit ready, it's not planning 1 month out, 3 months out, 6 months out. It's 1 to 2 years out. That's what I saw when I worked on Wall Street. Large, thoughtful companies are planning 1 to 2 years out. Really frustrates me that a lot of smaller entrepreneurs I speak to leave it too late, or just don't see the value of getting prepared early. So what does it mean to become exit ready? Here are some of the factors that we would include. There's lots of other things that one could include. For example, how you're using AI for efficiency. But it's like understanding acquired types, engaging the right support, having a super virtual data room with all the relevant data that a buyer would want, thinking about employee considerations. Do you need to have a new leader nominated now to make transition easier? Financials, a lot about financials in terms of accuracy for a lot of cash versus accrual accounting for a lot of e-commerce brands, audited statements. Look, there's a lot of things here, and this is just the tip of the iceberg. But I'd encourage entrepreneurs to really put a plan together so you can start ticking all these things off. To us at the Fortia Group, that's table stakes. If you don't do that, you're not really prepared. The icing on the cake is something that we call acquirer-led exit readiness. And it's a big part of a process that we do where we like to, when brands are coming to market on a 1 to 2 year view, we want to work with them and get them in front of acquirers now so that we can get feedback and incorporate that feedback. Because marriages take time, you want to ideally, as a seller, get bought, not sold. You want to really understand buyers' nuances so that you can have a tailored strategy for different buyers or different categories of buyers. By getting feedback early, you can address weaknesses. You can get really interesting insights as to who acquirers think are your competitors for benchmarking. You can think about positioning yourself as a strategic partner to meet their needs, their strategic, financial, and operational needs, and ultimately you can get a higher valuation. So for any of the sellers on the call today, we'd love to discuss with you actually having an acquirer-led exit-ready plan where we get you in front of acquirers. Okay, enough from the Fortia Group. Let's move on to the report. So we have super speakers for you today. Grips, as ever, are going to show us some really cool data. We've asked all the speakers today to have a tariff angle, which is obviously the topic du jour. Austin is kindly joining again from Drive Point, some really interesting valuation data, public comps. Nexus Capital, David, who spoke at our New York conference, is here. He's one of the most active FBA-led aggregators. And then to my two co-founders, Paul will talk about some operational brand metrics, and David will talk about the impact of tariffs and valuations. And then we'll get to Q&A. So I'll start by talking, just first of all, to remind certainly those people who haven't been on one of these webinars, rather than go straight to the valuation of brands, in our view, there's just so many things that go in the mix to get to that valuation. And ultimately, at the end of today's call, we'll give you our thoughts on FBA and DTC-led brand valuations. But you've got to think about, first of all, where's global M&A activity at? Where's the data points that Grips will talk about e-commerce trends? Drive Point, Austin will talk about public market comps because they affect private unlisted businesses. We'll talk about, is there any e-commerce M&A activity at the moment? And then we'll talk about brand metrics and deal dynamics, and tariffs clearly have a big impact on deal dynamics. Okay, so I will touch on briefly 2 slides on global M&A activity before I hand over to one of my fellow speakers. So what are the trends? What trends from an M&A perspective have we seen in the last quarter in Q1? Pretty grim reading, the first bullet point. So we're at a 2-decade low, 20-year low in terms of deals announced. So there was nearly 7,000 deals announced in Q1. That's the lowest since 2005. And I'll show you a chart to bring that to life in a moment. March did see some mega deals. So different to January and February, March was probably the best month from a mega deal perspective. Some of those were in the tech space. The PE exits are surging, which is interesting. 49% increase in PE exits. The deal volumes are rising, which means there's bigger deals getting done. The quantum of deals have gone down. So like there's clearly, some big M&A, global M&A deals getting done. An example of that is Alphabet's acquisition, and there's some big deals in the energy space. So that's a very high level summary of sort of the obvious major trends that we saw in Q1. So let's graph that, and it's not pretty reading. So again, this is the quantum of deals year to date on a like-by-like basis over the last 20 years. So we are all the way back to sort of pre-credit crunch stage. And I think when this data is updated in the next month or two, it's probably not going to be any better because the Trump tariffs are causing so much trauma, and uncertainty in markets, kills certainty and deal flow. So pretty grim reading, and that will have an impact on valuations and actually just getting deals done, which we can talk about as we go through today's call. Okay, let's get to the second sort of factor that goes into thinking about valuations, e-commerce trends, and I welcome Maximilian from Grips to the floor. Over to you, Max, please.
Thank you so much, Emmett. Yeah, I'm going to talk a bit about the...
Max, are you on mute? Please check if you're on mute.
Test. I'm getting a read as I can be heard. Can you hear me now?
You're good, yeah.
Okay, perfect. Thank you very much. All right, yeah, thanks, Emmett. We'll jump right into the impact of the US tariffs on the e-commerce market from a product and domain level perspective. Can I control the slides? Or yes, perfect. Yes, we're going to use two data sets that Grips is offering to our clients. One of that is the product level tracking, where we analyze across thousands of domains the product level sales, and also price tracking, which are of course going to be a focus today. And secondly, we also provide revenue and transaction estimates to e-commerce websites in the US, UK, and Germany with a lag of just about 24 hours. So this is quite timely data, which we need at these times. Please, the next slide. Yes, we're going to look first at the price increases of D2Cs, mostly on Shopify domains using the Shopify platform system. Next slide. Thanks. And here we can already see, first of all, how stable the general price is. We have a weighted price here that's weighted by the revenue and actually sales of the products. And we have just the median price across all products that are offered in the respective assortments. We're looking at the top 1,000 largest Shopify sellers by revenue here. We can see at the Black Friday, we have this little dip from the prices just going down. And then as soon as the tariffs are announced, we basically immediately see a rise in prices. Overall, we see a price increase of around 9% across all kinds of Shopify domains. And we also see that cheaper products, so anything that's below $30, is hit harder. So there we see price increases of up to 20%. Products that are above $100, $150 only have lower price increases at the moment, but there are increases to see across the board. Next slide, please. Yes, next we're going to look at Amazon categories, since we can deep dive there a bit into certain subcategories. Please go to the next slide. Thanks. And we picked the ones that saw the biggest increases in the last 2 to 3 weeks. As probably expected, perishable goods and products that are less stockable are hit first. So the entire grocery sector, even on Amazon, sees a lot of price increases. We have here lemons and garlic, which are predominantly imported by lemons from Mexico. Garlic, China is the biggest garlic producer in the world with around 80% market share. We see price changes of above 12% there, so this is already quite substantial. We have the eggs again. So although it was promised to get the prices down again, eggs are also imported a lot. So we see price increases there again. And what we also see in addition to these grocery and food products is we call them high volume and fast moving consumer electronics. So things like webcams and office shredders, products that are just bought a lot, increase in price as well, simply because the stock is probably decreasing too fast. And we see here the first FMCG target, or the first product category that's hit there with laundry detergents. If you click the next slide, you can see that a lot of this has actually been expected. So even in November, Forbes was predicting that garlic lovers are going to feel a problem in the US, and it seems that has become true. Logitech has even 2 weeks ago already said we're going to have a lower revenue in 2026. And since webcams are a large portion of their revenue, this is certainly going to be true. And again, like I said, we talked about the eggs already. Thank you. And lastly, so far we have mostly been focusing on price, and we can clearly see that the prices are going up. We are also going to look at actual revenue drops that we can see on two selected Chinese D2C companies. We are looking here at Temu and Shein. On the left-hand side, you can see the total revenue that these companies are making. On the right-hand side, we provide the year-over-year growth rate. And the tariffs were announced on April 4th. On April 9th, they were implemented. I believe on the 12th, they were increased again, then increased for another time. I'm sure you're all as confused as I am. What's not confusing is the definite drop that we see here. So Temu has dropped their revenue by almost 50%. Shein is not hit so hard yet. We believe this again has something to do with stocking that Shein already has in the country as compared to Temu. But if we see year over year, the development, Temu is still in a growth phase, although of course very, very far diminished. And Shein actually sees a negative growth for the first time. So we have some very strong effects here. What we already know for Temu is through multiple reports that not only have they increased their prices by up to 100%, depending on the category, they also stopped advertising completely, for example, through Google Shopping and other advertising. So they are definitely slowing down and scaling down the US market. The question that we're gonna work on in the next few weeks is if they're going to move their entire business towards Europe, shifting the advertising spend towards that as well. So this is the next effects that we're going to analyze. Yes, I think that was already it.
Great. Thank you, Max. Some interesting insights there, and great to have them so recent or live based on your data. Any questions for Max, folks? Please direct them via the Q&A tab, and we'll discuss that at the end. Thank you, Max. So let's move across to public market comparables, and I'll invite Austin to the floor.
Hey, good morning, everyone. Good morning, Emmett. Thank you for having me. For those of you who haven't been before and aren't familiar with us, DryPoint is a financial planning and analysis tool specifically for consumer and CPG brands. Part of what we do is track this basket of public securities that we've been watching for a number of years now, that sort of represent a crosscut of kind of modern e-commerce first retailers that are publicly traded. You can see some of the names here, and we'll go into detail on some of the others as well. So you can flip to the next one. Here's where we're standing in terms of the actual margins and EBITDA margins and sales. These are essentially, almost all of these should be considered sort of pre-tariff readings. So this will become our control period as we start looking at other pieces. But EV to EBITDA, that number trading up highly. Why don't we skip to the next slide? I mean, there may be a bug in that data here. So we can see sort of the trended multiples here. This is probably the best longitudinal data that we have on these comps and looking at where we stand. Interestingly, prior to a lot of the tariff stuff, we were seeing a ton of optimism in the market with our private companies, and looking at some of the public company data and some of the larger deals that are getting done, Poppy in the CPG space, being acquired by Pepsi, Alani Nu being a huge deal in the CPG space. So we actually saw quite an uptick in sort of large scale food and beverage M&A, and a lot of optimism around what's going on in terms of exit opportunities there. And you can see this sort of gently sloping upward trend line starting in about November of 2023, and with some of these data points, carrying us back to about a 10 handle. So we've seen some reflation in the EBITDA valuation multiples in the public markets here from a median perspective over the last 6 or 8 months. It'll be very interesting to see what happens going on from there. I think we're still in the new normal from a valuation perspective from my side, where we're counseling founders to, really your business is fundamentally not going to trade on revenue or sales, and we kind of see that in the public market comps. Doesn't really matter, how crazy you are. Everyone's sort of getting like a 1x basically on sales, and these are all against next 12 months numbers. Or excuse me, trailing 12 months numbers. So sales is not really a driver. It's really the EBITDA multiple that's going to continue to float. But we're seeing that median last reading at 9.1. We've gone up and above a 10 handle here on some of the weekly readings over the past 2 or 3 months. That seems to be a reasonable spot for brands with high subscription and high growth. Some of those private market comps have been coming in significantly higher than that. So again, we'll see what happens with tariffs, whether it's a slowdown, whether it has a deflationary effect on multiples here, but that's kind of where we're hanging out, loosely still trending positive. If you go to the next slide, just a couple of names to kind of highlight here. In terms of the two green arrows, the brands that are sort of the core outliers continue to be outliers here. So Lulu continues to be the gold standard as far as apparel and direct to consumer and best in class. We'll talk a little bit interesting about what they have going on with tariffs. They definitely have some exposure, and so we'll see what happens on that side. But trading at a high EBIT multiple, a high sales multiple, and really sort of the behemoth in the marketplace as they've continued to execute really, really well. The clear outlier on this table, and I think they had a great earnings report yesterday, and the stock is up, massively this year in ways that most of the others aren't, are Hims and Hers. So Hims has really, I think, is emerging as probably the principal case study in the power of a subscription direct to consumer model to drive very large scale outcomes. And it's fundamentally trading just differently than the other brands in this set. It's trading at a super high multiple. You can see EBITDA almost 70x here. And so it's trading more like a tech company. It's really getting valued because of that recurring subscription model. And a big breakthrough yesterday was some news on Wegovy that they're going to be allowed to sell a branded Wegovy product, and the stock popped again. So sort of like a very, very good case study in how these businesses can work at scale with the subscription mechanic. Some big news to the downside over the last couple of weeks out of this basket of names. Solo Brands looks like it's headed for BK. They have a pretty crushing debt facility in place. And so the stock is now trading at an enterprise value of less than 5 million after being acquired for or sort of put together and taken public as a house of brands, more or less. So Chubbies, which is an apparel brand, remains the gold star in the portfolio. That brand is doing well. It's growing. It's profitable. But they stapled it together with Oru Kyrix and Solo Stove and a couple of other businesses that have not performed as well. Raised some debt against the combined entity, and now that debt has sort of driven the enterprise value down. So we expect to see some sort of a deal or a BK or a breakup or a take private on that one, but literally has the ticker symbol DTC and has kind of been a really interesting case study there in the failure of this model on the other side. And I would say Allbirds, another one. Barely trading. DTC actually got delisted last week. Allbirds may be headed for a similar fate. So definitely, 2 or 3 years on to tracking this basket of securities, starting to see the real winners and losers kind of emerge, which has been interesting. This I just thought was interesting. I sort of went through a history of these public companies and sort of looking at how they've been responding to tariffs and what they're guiding as far as the potential impact. So following these arrows here, very interesting. This was May 29th, 2024. So a little over a year ago, we're talking about Lululemon making forecasts at that point, talking about a 20 basis point headwind due to tariff uncertainty and other things, right? And there are a number of other earnings and guides from around that time period into the fall of last year where people were sort of saying, hey, I think this is going to be, a couple of basis points hit to my COGS. And so I think just kind of underlining how much even these large public companies were caught off guard by the magnitude of change. They had all forecasted some impact, but no one was even really close. And so, even as recently as February, if you go down to the next arrow, Crocs was looking at saying a 10% tariff rate was embedded for China imports, right? And so as recently as February, a massive $1 billion publicly traded company was forecasting in only a 10% change from these rates. And obviously the rates that they saw in China are going to be far, far greater than that, at least in the short term. The latest one that we have, you do see in the earnings reports that are starting to come out now for the companies that have reported, including Carter, there are real actual mentions of alternative sourcing, people starting to talk about sales declines and other things. And so I think we've got really evidence of two things. One, that it is going to have a material impact on gross margins and prices. But two, that it is also having a material impact on how companies are thinking about their supply chain. And we certainly are seeing that in our slightly smaller data set. We're looking at companies primarily 20 to 500 million of revenue and seeing significant efforts of folks actually trying to move supply chain facilities around. So it is spurring action. How fast that action can take effect is very interesting. But I think an interesting timeline in terms of just like how rapidly changing the situation is, and how far off most of these companies were in their internal guides around what the impact would be here. You can go one more slide here, Emmett. The last thing I'll share, we just have some more private company benchmark data that we've now made available to customers. So putting our customers directly into the data set and being able to expose where they're stack ranking against benchmarks. So we have this data set popularized. The benchmark for COGS percentage across our entire data set heading into May is about 27.5%. So that's the percentage of net revenue that these companies are spending on COGS, and that'll be the benchmark that we're watching closely here over the next couple of months to see what happens to that average increase in COGS. We'll see where it lands, but I don't expect that 27.5% number will move too much, or excuse me, will stay constant for much longer.
Very good. Austin, thank you as ever. Some really interesting perspectives and up-to-date data there to give us all some thought regarding the impact of tariffs. Again, questions for either Max or Austin, please put it through the Q&A button. So on these webinars, we'd like to get a real buyer, an active buyer to the table. At this webinar, we have an FBA-led acquirer. We're hoping for the next webinar we'll have a DTC-led acquirer, just to show some balance between the two areas. So I'd like to welcome David to the floor from Nexus. Over to you, David.
Hi, Emmett. Hello, everybody. Good. So Emmett wanted me to share with you a little bit what's going on with Nexus and how we're operating in the space, given the tariff situation, given that the acquisitions on Amazon brands and, well, generally all e-commerce have slowed down since the big aggregators kind of like slowed down and started struggling a bit. And here he wanted me to share the last two acquisitions we did. They were like fairly small acquisitions, about $10 million each. One was in the beauty space, 11.8 million in sales, a bottom line of 2.5 million. It was growing 28%. We gave a pretty sexy offer, we think. The buyer was pretty happy with it, and it was obviously the highest offer they got. 3x cash at closing with 60 days of inventory including. And I think we paid maybe another, maybe 700 grand of the rest of the inventory that was there, that was sellable. Another deal we did was a little bit under 11 million in the health space, a little bit older. Bottom line is similar, 2.2 mil. This one, however, was going down and had shrunk quite a bit. So we ended up paying 2x cash at closing with the 60 days of inventory. And maybe we did another 500,000 of inventory at closing. And then we took another 1.5 million of their inventory in consignment. Obviously now with the tariffs, we're still pursuing deals. It's just adding an extra layer of complexity to it all, as we are currently also resourcing a few thousand of our own SKUs that were in China to other countries, a lot of India, Pakistan, Mexico. So anyway, same with any acquisition, that goes as part of the deal, right? We'll have to resource their lines so that it's not China. Fortunately for us, we started working on this whole China and moving out of China about 5 years ago when Trump started talking about it when he was last in the presidency. So we've moved quite a bit already, and we're kind of familiar with the drill. So now just going through the headache of 2,000 SKUs right now, but oh well. I guess looking into the future, I see this beautiful symbols. It looks like it's maybe confidential data, but all it said it was deal 1 and deal 2, and then the bottom one is M&A, I think, plans or something. But yeah, the plan is to continue to buy well-established growing brands, right? That most of their revenue comes from Amazon. We're also looking for opportunistic acquisitions that are being hit by the tariffs. And we're continuing to talk to aggregators and work with them to see if there's any assets there that we can take or acquire from them. Yeah, and I think that's what we're doing. Really, right now, a lot of work is going into figuring out new suppliers in different countries that provide the quality, the volume, and the prices that we need. And we're just working very heavily on that. And that's all I got, Emmett.
Very good, David. And just a question in terms of looking ahead for the rest of 2025, what if we get to the end of the year, how many more acquisitions would you like to have done?
I mean, it really depends on the size. Right now, we're talking one deal that's about 54 mil. So that's a little sexier of a deal. If I get 2 of those, then it'll be a very exciting year. For now, we're just trying to find them. This one we're very excited about, so hopefully we can all be happy at the end and close. But in terms of a number, I don't know, right? Like if I do another 2 of these, that'll be amazing. If I do 5 or 6 smaller ones, it would also be very exciting, but it's a bit rough, right? Because some of the sellers, as you mentioned earlier at the beginning, are not really prepared to sell, and they walk into the floor having heard maybe a 10x valuation back in the day 4 years ago from some cousin or something, and now that's not the market, right? So but yeah,
Very good.
Yeah.
Well, thank you for your time, David. And again, any questions for David on M&A? He's at the coal face of it in the FBA world. Please submit your questions, and we'll join David again at the panel in a few minutes' time.
Okay, thank you, Emmett.
Thank you, David. So now I'll hand over to my colleague, Paul. Are you there, Paul?
Hi, Emmett. Can you hear me?
Loud and clear.
Great. Thanks. I'll introduce brand metrics. So when we talk about brand metrics, of course, we've got financial metrics and operational metrics. My background prior to Fortia Group was in e-commerce operations. So I'm going to focus largely on operational metrics. And how do operational metrics impact valuations? Effectively, why I think a theme so far has been acquirers are searching for increased certainty. As Emmett says, uncertainty is never good in the market. So threefold for me. So from borrowing costs translating to business worth. Obviously, most e-commerce brands are being acquired with capital, be it a debt, be it equity or some form of blend. But obviously, cost of capital for acquirers has a direct impact on valuations they can offer for brands, how they can structure deals, etc. And quite frankly, their general appetite to get deals done. As Emmett said, there are less and less deals done right now due to some uncertainties in the market. The second is these assets, unlike certain other sectors, are propped up by consumer demand. Consumer demand is something we all live with, sellers, acquirers on the call. And it's incredibly unstable, has been ever since pretty much COVID. COVID came, there was a huge acceleration. The high street was dead, it never came back. Guess what? It came back, and we had a lot of geopolitical activity, be it wars, be it political campaigns more recently, impacting consumer demand. That's driving uncertainty. And then threefold, obviously, since COVID, there's been a huge balloon of the lower middle market sector, particularly commerce. And acquirers are searching for less risky assets with high growth potential, consumer competitiveness, and the sheer quantum of assets that are in market complicating things. Muddies the water a bit. So good brands need to have the ability to showcase that they have large, sustainable future growth opportunities. We do a lot of work, for example, with our clients in forecasting, building robust data-driven forecast sets. The important thing to note is, while many of the sellers on the call will be scrambling with, supply chain costs, gross margin, recoups, looking at pricing, etc., acquirers are also going through the same things, right? They have assets under management. Heroes, Licio Bruni, good friend of Fortia. If you don't follow him on LinkedIn, I implore you to do so. He may be on the call, I'm not sure, but been taking a lot of inspiration from his posts lately. LinkedIn not always the most transparent, real platform, but over the last week or two, he's been posting live, real life examples of how tariffs and or impacting cost of duties on a core set of products. We're talking about 1,000% increases in some cases. So, you know, this has a real impact on acquirers as well as brands. Next slide, Emma. So I said I'd focus on operational metrics. In the interest of time, I'm going to focus on one. Obviously, for financial, you know, important brand metrics to display would be, you know, revenue growth, net margin, sustainability, contribution margin, showing that you've got strong contribution margin all the way through, and that you've got a good handle on your investments. But for operational metrics, there's quite a lot that we could go into, but for here, I just want to focus on LTV to CAC, still remaining the golden metric. Not because, you know, it's a one glance metric, just get a view as to what the brand is doing, but the fact that it's so encompassing, right? You know, it's incorporating things like pricing strategy and how your pricing more recently is correlating to your gross margin. You know, how you could be looking at different pricing strategies to offset some of the tariffs being driven within your supply chain, especially if you're sourcing from China right now. You know, it also speaks to some marketing plays like customer retention strategy, your repeat purchase rate. Also speaks to things like recurring revenue for e-commerce brands, often referred to as the golden metric right now, because again, acquirers are searching for certainty. Getting a good handle on this is super key, because especially when it comes to forecasting. So your LTV to CAC dealing with during the operational phase of the business, and your current over the last 12 months, last 2 to 3 years, being able to showcase this and how you've been developing is super key, but also helps to then forecast your future growth, expanding into new markets, expanding into new customer segments, expanding media channels. I guess some large part of this is why often we see a premium set on DTC businesses versus maybe marketplace-led businesses, because they have more handle on a lot of the different aspects that are impacting the LTV to CAC ratio. And then for anyone, of course, we'll all be aware on the right side, but 3 to 1, less than 3 to 1 being high risk. High risk right now because it generally means that acquirer is going to have to incorporate it into the portfolio and fix things right away. Of course, tariffs for everyone is meaning we're having to fix quite a lot of it. So no need to inbound additional risk. 3 to 1 to 5 to 1 moderate risk, deemed a good asset. And of course, anything above 5 to 1 ratio probably means that they're under invested in marketing, certain media channels, and of course, acquirers these capital in this area. So should be good room for growth. Next slide. Finally, I just want to speak to something that Emmett touched about. So we have exit ready programs that we put our clients through anywhere from 1 to 3 years out. The key message here is brands don't have to go alone. Often when you're handling the current impact tariffs are having, or you're looking at how this impacts future forecasts, planning, or even your exit strategy, you know, acquirers, strategic acquirers are going through the exact same thing. They have assets under management, figuring all this out. Often in the lower middle market sector, certainly in our experience, we're seeing a lot of brands that don't have boards, they lack advisors. Effectively, the C-suite or leadership team are making all the sole decisions. There's a wealth of experience around them that can be brought on board. So we're currently working with clients under something called acquirer-led feedback, which is effectively a 3-month project-based commitment, meaning it's not an ongoing commitment to Fortia, but it's a project-based commitment whereby we can analyze your brand and create a detailed teaser so that we can connect you with relevant acquirers that will be best positioned for feedback depending on what stage your brand is at, whether it's in scale mode, whether it's in growth mode, whether it's in, you know, the end of the exit strategy kind of type, where you're looking for, you know, how do you squeeze the last few dollars out of your growth strategy prior to exit. The way it works then is we prepare you for 1-hour collaborative sessions with these relevant acquirers. And then effectively what you get is a large amount of feedback, advice, and strategy execution advice. We then take all this, give our own feedback and thought on top. We produce a structured, detailed report that's easy for you to digest. And effectively, then you take that away and you integrate it into your growth strategy. You get a super valuable teaser that's awesome for having communications with future acquirer targets. You get to build a network with relationships, build relationships with acquirers. So if anyone would like to learn more about the acquirer-led feedback project that we're running, please reach out to Emmett or myself to talk to you about it in more depth.
Great.
Thank you.
Thank you, Paul. So before we get into the actual valuations, we want to talk about the sixth factor that goes into the thinking, which is deal dynamics. This could be, for example, increasing cost of capital for acquirers has an impact on deal flow. It could be back in the good days, acquirers had to put money to work by X date. It could be a seller is forced to sell because they were under personal pressure. It could be lots of things, right? But today, given the theme of the webinar and the global e-commerce world, we want to focus in on the impact of tariffs on deal dynamics. So I will hand over to my colleague David to take you through this.
Good morning, everyone. In the interest of time and trying to get quickly towards the panel, I'm going to rattle through this as quickly as I can. So when we're looking at deal dynamics, we're speaking to a lot of buyers out there, and we're trying to understand how they're going to adapt to acquisitions and investments at this sort of time. So we're going to look at a couple of the topics that have been raised, essentially how they're going to look at financial due diligence, how they're going to look at supply chains and the risk associated with them, potential adjustments to their valuation methodologies, and obviously how that all will be essentially reflected in a deal structure. Sustainability analysis of your margin is key. Acquirer is going to look at your unit margin and determine if there's any cushion in there to essentially help to absorb the impact of these tariffs. A lot of this is going to be based, on data. So it's really important to have your data in place to understand what your true costs are now and what they are in the future. Looking at artificial and performance inflation, a lot of people will have potentially invested in a lot of stock to get it through before these potential tariffs are influx. As Maximilian referenced, Shein, we didn't see a significant drop off in Shein like we did with Temu, and a lot of that had to do with them having stock potentially onshore at this time. This performance inflation and potentially under declaring the value of goods at the border are potential impacts to the financial reporting of the business. So you just need to be very conscious of that. And looking at price elasticity, obviously quite a difficult one to do, particularly when we're entering a time of consumer sentiment and we're not quite sure how that's going to impact. But those brands with a capital B, you would hope have a relatively inelastic impact. And what we want to determine here is can the business pass on the full cost or a portion of the cost onto the business. Can you move to the next slide, please? Looking at the supply chain, obviously China is essentially a persona non grata for supply chain at this moment in time. A lot of sellers are actually looking at alternatives, whether it be Cambodia, India, other low-cost manufacturing jurisdictions. As we start to see trade deals signed come through, that is a significant opportunity for them to essentially move supply chain. Now, obviously, you're leaving a lot of relationship behind, which is challenging. So the task is to try and really build those future relationships, but that is a risk to a potential buyer. Soft supplier relationships are a real challenge. Obviously, the opportunity to bring things into a nearshore, into a jurisdiction that doesn't fall under this sort of de minimis, the de minimis rule, is an interesting opportunity. Are there opportunities to onshore within the US, or look at other Central America or South American opportunities? Obviously, the de minimis rule was introduced in 1938, I think it was, really to stem global trade. It has fueled e-commerce growth. So we're seeing a significant impact of that on any goods coming from China. China had I think over at least 50% of the cargo shipments that came to the US were from China and fell under that de minimis rule. So that's going to have a significant impact for these businesses moving forward. Next slide, please. So how are people actually looking at, or how are investors looking at businesses and determining, what value to apply to them? Obviously, trying to normalize earnings to reflect what the impact of tariffs are at the moment or what they can be in the future is going to be a significant challenge. We're in a time of uncertainty. So a decision and performance now may not necessarily be the decision of the performance in the future. So a lot of work has to go into the sort of modeling of this. The foundation to any business essentially is a model. We often see, acquirers want to pay for the past, but they want to buy for the future. So they're always looking at different scenarios, potential increases. There may be a high, low, medium potential scenario valuation. So that is going to be, very difficult as to how that actually maps out. Forecasting challenges. Austin mentioned that Lululemon, multi-billion-dollar retailer, wasn't able to correctly forecast the potential impact for this business. So it's going to be very difficult for others within the space, including the sort of smaller investors, to do that same thing. So all this uncertainty is going to ultimately impact on how deals are structured. Let's move to the next slide. A buyer is going to want to try and reallocate the risk, the balance of the risk across within the transaction. So that may be asking the seller to, assume the risk of potential impacts in the future. Now, obviously, we would never advise anyone to indemnify an unknown, but there may be opportunities to flex that and to assume a little bit more risk than you would have in the past to try and get a deal done. Adverse effect clauses. So there's always a pause between signing and actually completion of a deal. And we're seeing things change in such a short period of time here. A buyer may want to insert a clause that protects them in the case of a significant adverse change. That is going to be a challenge moving forward, especially when you're at that stage of a deal. And it could be the torpedo for the deal if material adverse takes effect. So people need to protect themselves also, looking at that. Do you have an opportunity to pull in the event that such an event happens? And earn-out structures. There is a potential here to essentially assume risk with a higher payout. In the event that there is an earn-out structure, buyers are going to want to back-end a significant portion. You should always try and stretch that portion to balance the additional risk that you're taking on for not getting upfront fees. So that is something that, it's very important to enter those negotiations with that in mind, that if there is a back-ended element, you really need to try and push that boat out and acquire, assume as risk, but acquire a huge opportunity in the future.
Great, thank you, David. So where do we think valuations are today? First of all, I want to take a step back. Just quickly remind you of all the factors that go into valuation that we've discussed. We've discussed global M&A. Max discussed e-commerce trends. Austin discussed public market comps. David discussed M&A activity from the FBA side of things. Paul discussed brand metrics, and David finished up with the impact of tariffs. So all of those things factor into valuation. Before we give you our thoughts on valuation today, we always like to look back. We have a sort of scorecard methodology to coming up with valuation. So look, December 2021 was the high. That's when it was the perfect storm. Loads of M&A activity, great e-commerce trends, listed companies were flying, loads of e-commerce M&A activity. Brand metrics were relatively easier to look good, and the deal dynamics were great. Loads of buyers, loads of aggregators in particular. So that led to super valuation multiples. The highest valuation multiple we ever heard of over the last 5 years for an FBA business is 7 times. That's for like a diamond at the time. DTC-led businesses went well into the teens if they're large and have recurring revenue. So that's where we were December 2021. Last summer was the low. So July 2024 was the low. If you remember, early in 2024, we had hoped that interest rates would start coming down in June, which they didn't. That got pushed out. and global M&A was low. Everyone was waiting for interest rates to come down. So M&A, both global, other sectors, and e-com was low. E-commerce trends were tough coming off the back of COVID still. Listed comps weren't great. It was tough from a deal perspective. So we scored that 19 out of 60. So last summer, most brands that were growing and profitable were trading between sort of 2 and 3.5 times for FBA and 2.5 times to 8 times for DTC. Things did sort of begin to improve. We called it brighter outlook for October last year. We start to see a bit more improvement on the back of interest rates coming down, particularly in public comps. Probably the biggest upswing was in the rebound in the public comps and global M&A activity. E-com activity was still relatively muted, but deal dynamics were beginning to improve. People felt like with interest rates coming down, there'd be more of a positive outlook towards doing deals. Then at the start of this year, we called it optimism returns. This is when we had our New York conference in January. So it felt like the whole geopolitical thing of the election was done. Interest rates were coming down, and that we would see a return to more deal flow. So there were a decent volume of deals getting done, certainly in Q4. You've seen from earlier on, it didn't follow through in terms of volume count in Q1. Public market comps were still doing well. So a few months ago, we called it optimism returns. What does that mean in practice? It meant that growing and profitable FBA-led brands were trading at 2 to 4 times. That includes upfront and deferred consideration. And on the DTC side, it was anywhere from sort of 3 to 9 times. There's always exceptions to the upside and downside, both for distressed brands and diamonds. Unfortunately, as of now, we're calling it tariff trauma. It's the new low. It's the lowest we've seen in 5 years. Our score is 18 out of 60 on the scorecard. So, tariffs have brought serious uncertainty. Uncertainty is the most hated word from a market perspective. As all you guys know on the call, it's caused major disruptions. So deal count is down. So M&A isn't a great score. E-commerce trends are tough because there's loads of uncertainty. Public market comps are down, as Austin showed. E-com activity is the lowest right now as of April. Hopefully it'll improve in May, June. But right now we're not seeing that much deal flow, both on FBA and DTC. We are live with deals and hope to close. But if you're an acquirer, you'd want to see a change of supply chain or cost passed onto the consumer before you would pull the trigger. So really tough. Deal dynamics are tough. So unfortunately, it's really, really bearish right now. It's unlikely to see many deals in Q2 2025. Hopefully, when there's some clarity at the end of the 90-day period, this can change. And the next time we speak, hopefully it's much more positive and we've got less uncertainty. So today, what does that mean? For growing and profitable brands, we're saying between 1.5 and 3 times. And diamonds in the FBA space are trading between 3.5 and 5 times. And for DTC-led brands, then you can see it there. It's sort of 2 to 6 times for growing and profitable brands. DTC-led brands are always higher value than FBA-led brands because they own the customer and have more of a chance of having recurring revenue instead of repeat purchases, etc. So yeah, pretty bearish finish to the webinar, but we'd rather be frank with you all based on what we're seeing. We don't expect much M&A activity in e-com brand world in Q2 2025. So with that, we'll go to Q&A. If I could ask all the speakers to please turn on their cameras again, and we've got 4 minutes. So let's go to questions. So the first question is, do you have any thoughts about top strategies brands are using to mitigate FBA Amazon channel risk? Maybe a question for David.
David Fortia or David Nexus?
David Nexus.
I mean, sure. I mean, it would be moving out of Amazon, right? We're on retail, we're on Walmart, we're on all the other .coms that are out there. But in terms of mitigating I don't know how much we're mitigating. Really, the way we're mitigating is just by making sure that the tariff situation is not affecting us by moving the supply chain outside of China. Because even though we're selling on retail and on every .com we've been able to get on and wholesale, most of our revenue continues to come from Amazon. So for us, we'll continue to push all the other avenues, obviously, and DTC and Google Ads and Meta and whatnot, but we really need to resolve the last few thousand SKUs that we still have in China.
Mm-hmm. Austin?
Yeah, the only thing I was going to add is that we have a number of customers who've been able to see some early success with TikTok Shop, which is a similar marketplace model with a similar fulfillment model to Amazon, especially customers that are relatively lower AOV products. We have a number of customers, five or seven customers who have seen TikTok pretty quickly scale to 20 to 30% of their total revenue on the TikTok Shop platform. So obviously plenty of uncertainty with TikTok as well. But for those brands who've made the bet and are investing, we're seeing decent returns.
Very good. We have 2 minutes left. Any sort of final comments from Max, David, or Austin, or sort of thoughts about the outlook in the coming weeks and months? It's hard to look too far ahead given there's so much happening.
Well, I think it's exciting times, right? For all of us in this space with this whole tariff situation. Is something that could potentially be great to our country, but to us individual sellers, it's putting a big hurdle, which we'll see if it was worth the work and effort to get out of it, right? If this can hold for 5, 10, 15 years, I think it will make the United States a serious force and a serious economy to contend with. And but we'll see, right? But for now, it's, I guess, pretty exciting just to move thousands of SKUs out of China. And, you know, some people are cheating and bringing fake invoices. So now they're starting to inspect containers because they're coming undervalued. So now the government's creating this whole force of, I don't know what they're calling these agents, to inspect all the incoming products from China. You know, now you have all this DDP that they'll handle everything for you. But again, I don't want to commit a federal crime, so I'm trying to just find suppliers elsewhere. But yeah, I think as anything else, it'll also probably bring some opportunity, you know, if we were able to find it and see it, and, you know, keep pushing through. We're trying to make our inventory last as long as we can, you know, lowering our ad spend, raising our prices a little bit, and extending our 5-6 months of inventory to 10 to 12 while we get new factories providing the quality and prices we need elsewhere. That's what we're doing. I mean, it's just keeping us very busy.
Very good. Thank you, David. Any closing remarks, Max or Austin?
The only other thing I'd say is, you know, we're encouraging our customers to not forget to model the upside scenarios here as well. Like there's plenty of downside opportunities that are easy to model. The number one thing is on, I think, changing product costs and what the impact of that might be. And then the other downdraft is just general demand dampening of consumer softness that we're asking people to model to say like, okay, regardless of what happens to your COGS, we should expect some potential downdraft. But I also think that there is an upside scenario not to forget about, which is, you know, no one is highly incentivized to keep these tariffs on for a super long period of time and not to arrive at good trade outcomes. And I think there's a world in which we arrive at in a very different Q4 than what we have now. And so brands that have an opportunity to be aggressive or maybe have a little bit of an edge, it's an amazing time to separate yourself from the pack if you're willing to take that risk. So don't forget the opportunity side of the coin here, I think is maybe a final closing thought. If you guys are, you know, there is a gamble and win path for those who are willing to take the risk.
Yeah. Thank you for the positive spin. Max, to finish.
Yeah, going to the same direction. I'm really curious to see how substitution in certain categories is going to work, and companies who are able to not give the tariffs directly to the customers, but sort of push through it by holding the price and pushing others out of the market and increasing market share through that. So there's definitely opportunity in this for sure.
Well, thank you to you all for joining. And when we have our next webinar in October, hopefully the world's a more positive and settled place for everyone involved. Hope you enjoyed today's talk. We'll follow up with the recording and the PDF in the coming days. Thank you all for your time. Have a great day. Take care. Bye-bye.
Thanks, Emmett.